It's a big week for the UK markets with the Bank of England meeting and lots of data. But it's events across the Atlantic that could well matter more. The US Federal Reserve meets, and following some disappointing data on US inflation, they may take a cautious line that leads markets to delay and reduce the pace of interest rate cuts that they expect. And that would impact interest rate expectations across the globe. But in this week's Market Perspectives, I explain why I think we remain on course for steep cuts in interest rates, both in the US, UK, and Europe. So let's start with that US data. First of all, consumer price inflation numbers came in above expectations. Only by a smidgen, but that followed a bigger miss the previous month. But the real blow came later in the week, when producer prices rose significantly and well above expectations. Now, unlike producer price series in other countries, the US numbers cover the whole economy, so they really do represent price rises in the pipeline. As a result, markets have reassessed the prospects for US interest rate cuts. The odds on a cut in June, regarded as pretty much a certainty at the start of the month, it's become little more than a 50-50 bet. And the total number of cuts expected for this year went down from 4 to 3. Indeed, it's possible that the Federal Reserve signal with their dot plots that they expect only 2 cuts this year when they meet this week. Now, my own view is that this pessimism is overdone, and let me explain why. First, a little bit of strength in US inflation in the early months of this year is not really surprising given the strength of the economy at the end of last year. Real GDP then grew by nearly 5% in the third quarter and 3.2% in the fourth quarter. And that's measured as a quarter-on-quarter annualized basis, by the way. Either way, the numbers were much stronger than expected. And indeed, employment rose by over 1 million in the last 5 months. They're big numbers. Now, the US is a highly flexible economy and prices react quickly when demand is strong. But there are clear signs to me that the economy is now slowing. Consumers, they were a powerful factor behind the strong growth last year, and some of the special factors behind that strength no longer apply. Firstly, COLAs. They are cost of living adjustments to Social Security payments, and last year, COLAs were 8.7%, and that gave a big boost to the incomes of some 70 million Americans, and it accounted for fully half of the 4.2% rise in real total household incomes. This year's COLAs will be much smaller, just 3.2%, and overall real incomes, they're set to rise by just 2%. Second, US consumers, they were drawing down on their COVID piggy banks last year. Yes, all that money that was received from the government during the pandemic, but couldn't be spent due to lockdown. Well, that's been spent now. And you can see this effect in the US saving ratio. That measures the proportion of income which isn't spent. And that ratio has fallen below the pre-COVID average. And it'll have to edge higher. And as it does so, US consumers will have to slow their spending. Finally, mortgage rates, they're on the way up, reversing much of the decline seen last year. And at the margin, that would slow the housing market, further denting overall spending. Now, all of this is beginning to show up in the data if you look carefully. Retail sales, they've slowed, but also small business surveys are showing that hiring plans are being pared back. And we expect employment growth to slow significantly in the coming months. And all of this should reduce inflation pressures. And remember, as far as we read the numbers, wage inflation is getting quite subdued now, and it's already pretty close to the level that would sustain the Fed's 2% inflation target. Back in the UK, this week should see a big fall in our inflation rate. No doubt the Bank of England will warn of the dangers of cutting interest rates too soon, but I expect the UK inflation rate to hit the 2% target next month and to stay there for the rest of the year, even as the economy picks up. The housing market is already recovering, with right-move prices early on in the price cycle rising strongly in the latest data. Over in Europe, the European Central Bank have already guided us to expect a rate cut in June, and the economy there is recovering, but only slowly, very slowly. Now, it could be a difficult couple of weeks as the US Federal Reserve take a cautious line. But longer term, the outlook is distinctly positive, in my opinion. Now, there won't be a video podcast from me next week as it's Easter week, and I'll be doing my monthly webinar on Monday the 25th, and there'll be lots more detail on the outlook for economies and interest rates and markets in that webinar. If you're interested and haven't signed up, please contact your Columbia Threadneedle Investments representative. Until then, goodbye from me.